Welcome to MHN Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. Today, we'll provide an outlook on multifamily investment. I'm Suzanne Silverman, Editorial Director of Multi-Housing News, and I'm here today with 5 industry leaders. Ann King, Co-Head of Institutional Solutions for Berkadia, Jon Siegel, Co-Founder and Chief Investment Officer for RailField Partners, Jeff Adler, Vice President of Yardi Matrix, Melissa Farrell, Head of U.S. Debt Originations for PGIM Real Estate, and Josh Westerberg, Executive Director for Mesa West Capital. We're recording this session and it will be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. And thank you to those of you who submitted some in advance. We'll try to get to as many as possible. To kick off today's webinar, Jeff is going to provide a snapshot of the U.S. economy and multifamily performance. Then we'll jump into an in-depth discussion among all of our panelists, providing perspective from both the lenders and investors' sides. Jeff, I'll hand things over to you.
Well, thank you, Sue. I wanted you to advance the slide. So just to set a context, we see the economy slowly decelerating. Second quarter numbers just came out, I think, this morning, are pretty good. But there are a set of indicators in terms of both money supply and other economic activity, inversion of the yield curve, other areas. We do see a slowing of the labor market, slowing of the economy, a slowing of inflation at the same time, leading to a mild-ish recession. We think fourth quarter could be the first half, but we're basically talking about something in that line. I know the Fed doesn't necessarily share my view, but I don't think things are different this time. I've been through a few cycles enough to believe that, in fact, it is the same. Let's go to the next slide. In terms of inflation, we definitely are on the back end of the cycle, both in terms of money supply, commodity prices, transportation prices, fuel, food, and other areas like that. The rent indicator is also beginning to come down, and that's about between 25 and 34% of the Fed of the metrics, depending if you're using personal consumption expenditures or CPI, and the decline that started in asking rents in the spring of 2022 is only now beginning to work its way through into these metrics. So I think we'll be in around 2.5, something under 3, 2.5-ish come the end of the year, and that kind of gets close to where the Fed's goal is. And the labor market is still good, but is not as good as it was. Let's go to the next slide. Then when we look at the shifting over to the multifamily sector, rent growth is kind of weak this season. Okay, so I find this sort of monthly series quite interesting. So if you look at the seasonal uptick, very, 21 was crazy strong, 22 was pretty strong. You're back to sort of an 18, even weaker than 19 kind of number. And on a year-over-year basis, I think June numbers were 1.8% year-over-year, separate depending upon the markets that were getting a lot of supply, where it's concentrated, and also at the lower end of the market, which is less prone to supply pressure. So let's go to the next slide. And if you look at this is rent growth over the course for June. You can see some interesting kind of markets that are still doing reasonably well. You kind of have the Boston, the Northeast with New York, the New York area, Chicago, and then some other sort of like markets. And I'll go over some markets that in the Midwest that didn't even hit this list. And you're seeing a reaction as supply has responded to demand in some of the most popular kind of tech hub markets. They will go through a difficult 18 to 24 months as that supply gets delivered, gets absorbed, and basically setting up for another cycle come 25 to 27. But those markets will be in a bit of a struggle. Now, if we go to the next slide, if you look at long-term supply, and this is our forecast of supply over the next 5 years, it's not crazy, right? This is reasonable amounts of supply given population and migration growth, which has slowed down. However, if you go from a 5-year perspective to a 2-year perspective, let's go to the next slide, the final one, we do have some markets that are going to get a lot of supply in the short term, and they are going to go through struggles in terms of absorption. Austin, Miami less so. Fort Lauderdale and West Palm Beach is being more impacted, but Raleigh, Salt Lake, Charlotte, Nashville, Jacksonville, Phoenix. I could also throw in Denver and Atlanta. These are great cities with great long-term prospects that are going through a normal cyclical reaction to demand. The supply comes in, it has to get worked out. But these economies have grown at something, if you look at a 50-year average, something like 4 to 5 times the level of population growth of the major kind of core cities. So I'm bullish on these cities long-term. Short-term, they're going to struggle a little bit. So I think that's the last slide. And I'll turn it back to you.
Thanks so much for setting the stage, Jeff.
Sure.
Let's begin our discussion by looking at liquidity in the market, starting with the investment side. Mary Ann, can you start us off by giving us insight into the kinds of sales you're seeing happening?
Certainly. Well, first, good morning, Suzanne, and thanks so much for inviting all of us to be with you this morning. I don't think it should be any surprise to any of our listeners that the dramatic increase in interest rates that we've all seen over the last 16 months has really stressed liquidity in all commercial real estate sectors, even in apartments, which are probably the best of the sectors. During the first 6 months of 2023, apartment volume, the transaction volume was actually down by 67%, 67% less than the volume for the first 6 months of 2022. And I would say that virtually all of the investors that are putting deals on the market are prompted by some sort of stress. And I wouldn't call it distress, but I would say that they're prompted by some sort of stress. Many investors have loan maturities coming up, or they have expiring caps. Virtually all of the large core funds have large redemption queues. Many of the sponsors of closed-end funds are finding themselves really jammed up against the end date of their funds. Other developers that have finished construction of their new apartment properties, they need to sell their asset and pay off their construction loan. So these are all investors that would like to sell assets to maintain liquidity. But as interest rates have increased, many of these investors have found that their asset values have fallen anywhere between 15 and 25%. Huge declines in asset values. So they pull their deals off the market and they wait. And that has created a bid-ask spread that has really created the liquidity problem. The deals that are getting done today are either for sellers that don't have the luxury of waiting, or more likely for sellers that believe that interest rates will stay higher for longer, and they don't believe that pricing will recover within the time frame in which they need to create liquidity. So those are the kinds of deals we're seeing coming to the market today.
And what about the buying side? John, who's buying? What types of investors are active right now?
Well, I think that most people believe in the multifamily story long term. So I think most investors that you talk to, I know most of the investors that we talk to, will tell you that they're still either in the market or they still believe in multifamily. I think we could probably segment those buyers though into two groups. One, I think there's a lot of people who are just looking for a deal. You hear the word distress, which I'm sure we'll talk about some, and I know Marion said stress. You can read the headlines. And so I think there's a lot of people who think there's a deal out there. I don't know personally that I've seen a lot of those right now. There's not a lot of great deals, but there are deals to be made, and there are people that are in the market. I think we're seeing more private capital than institutional capital. I know we have a number of institutional capital relationships. They're certainly in the market and looking for deals, but their return requirements have gone up. And I think more of our private capital relationships are still looking at deals more holistically, maybe, and saying, okay, maybe the interest rate's higher, but I believe in the market long term. So I think you have a lot of money still on the sidelines, a lot of people that want to do deals. It's fewer and further between the people that are actually executing right now.
Mary Ann, you're nodding. Do you have something else you want to add to that?
No, I think we are seeing more people come to all of our auctions, and more people bidding on deals, more people touring, more people looking that, claim that they're actionable, but they're all looking for, cash flows that are accretive to their debt. And those deals, many of those deals aren't out there yet. Yeah. So that's what's creating that bid-ask spread.
Yeah, I mean, as a good example, we had a big institutional investor that we've done business with before, and we've been talking to them, and they said, hey, we'd like to do some more. Let's set up a new venture to do some more deals. And I said, great, always looking for more money. And they came to me and they said, okay, if you could come to us, bring us some deals at 55% loan to value on newer deals, and bring us a 16% IRR.
Yeah.
Yeah, sure. Yeah.
Yeah.
I haven't seen one of those in 5 years, and I'm not sure I'd see one soon anyway. So that there's a lot of that out there right now. So this year we've closed one deal this year. We bought one deal which had a seller profile similar to what Mary Ann said.
Yeah.
And it's tough, but you got to keep. I always say to people that you won't know when the market changes if you're not in the market. So like if you're going to read about it or watch us talk about it, we're not going to tell you about it until it's too late, right? So you got to be in the market at all times.
There is a sort of a class of multifamily properties that are sort of in the power lane that Mary Ann's describing. So usually it fits with things that were done in 2021. So you didn't get a lot of rent growth. And they happen to have, either variable rate notes or they did bridge financing. And so that's the sort of the window. It's not a huge number, but it's several thousand potential out of maybe a universe of 105, 106,000 properties. So it's I call it the needle in the haystack. There are needles in the haystack for those kinds of stressed opportunities. But even that sort of like potential set of needles, not every one of those owners needs liquidity. They might say, well, you know what, I'll do a capital call, I'll do this, I'll do that, I'll suck it up. So you are, again, truly finding a set of needles in the haystack, at least in terms of existing assets. We're talking about new construction financing, a little bit different.
Yeah. And I know we'll get more into this on the debt side later, but I would say this definitely resonates with lenders in terms of what you're all saying, because the majority of what we're working on right now are refinances, right? So people that are saying, okay, I'm going to wait till things get a little better to be able to go out to market to sell. And so we're being kind of inundated with requests for shorter term fixed rate loans with lots of prepay flexibility, because no one wants to go floating right now, because obviously the SOFR rates are over 5%. So everyone's really focused on that. If we do see a few acquisitions, but exactly what you're all saying, it has to be something with an increase in cash flow that's going to make sense. So maybe you go in at a lower cap rate today to, for the acquisition, but you see those higher cash flows down the road as well. So yeah, exactly what's happening.
Yeah, and to follow on real quick, what Melissa was saying, agree with everything she said. It is interesting on the debt capital market side, there is a lot of liquidity. We get asked about the regional banking crisis and how that's impacted liquidity in all sectors. But in the multifamily sector, yes, and the regional banks and in the banking sector may have pulled back a little bit, but they're only an element of multifamily property financing. Life companies, agency, and alternative lenders such as us at Mesa West. There's a lot of liquidity in the markets, but as John and Mary Ann had alluded to, when we're talking about rates where they are, it's just difficult to transact, which is why debt capital markets are kind of, pushing buyers to underwrite in a way that they're just not getting to their yields in this environment, which is making transaction activity very few and far between. And as Melissa had said, we're really seeing as a result of that just refinance opportunities. But there is debt liquidity out there. It's just really expensive right now, unfortunately.
Yeah, and on the acquisition side, I think the whole equation basically a lot of boils down to the concept of positive leverage. And before it was awfully easy, and so now if you have your first mortgage at 5.5%, obviously the cap rate needs to be either at 5.5 or if you're going in below. And so the pitch that we get 10 times a day now is, well, you're going in at 4 or something, but it'll be 5.5 after the first year. And so to get there though, to do the math on that, you think about how much the rent has to grow or the value add play has to really work. And obviously, going back to what Jeff was showing us before, rent growth is slowed. So it's hard to actually, with conviction, do that math and say, okay, I'm going to go in at a 475 and be at 5.5, in a year. That doesn't always pencil out. And so there's
I would say not till 26.
Yeah.
Honestly.
Yeah. And there's our stalemate right there.
Are you seeing investors being reasonable or realistic about their rent growth assumptions?
I think investors are, and I think again that plays back into the bid-ask spread. I think
Mhm.
most investors and everybody we talk to is, yeah, like 2 years ago to do a deal, we would pro forma, oh, we'll just do 10% rent growth in the first year and 7% in the second year. Those days are long gone. And so if you're sticking with the standard issue 3%, it's just, that just doesn't pencil out to get there. So obviously the cap rate going in has to be higher, and sellers just don't want to go there yet. And I understand that as a seller sometimes too. It's just, that's the way the market works.
Yeah. And all of this has been happening in a changing environment. We've found that as interest rates look like, or as the 10-year treasury looked like it was stabilizing for 60 or 90 days, you'd see capital bleed into the market and people trying to make deals. And then interest rates would move again 25 to 50 basis points, and all those deals would fall out. And a seller that thought he was a seller at market all of a sudden said, not that market. So I think it's the change in the market and the lack of transparency at that change, which has made buying and selling more difficult.
Obviously, multifamily for a while has been a favorite asset class. How are investors viewing multifamily now compared to other property types?
Well,
Jeff.
yeah, I mean, I think if you look at this across the kind of the major food groups, multifamily and industrial remain the most favored asset types. Okay. And it makes perfect sense. Multifamily, there is a structural shortage of housing in the United States, particularly in places where people want to live. And that's driving both demand and a need for housing and rent growth. And it's also, in reaction to it, driving regulatory pressures in certain jurisdictions. Okay, so which is actually funneling capital into fewer places than otherwise would be the case. Industrial is really an ongoing growth of the movement of but two really big things. One is e-commerce continues to penetrate at a more normal rate. Kind of COVID was a big increase, and now it's back to trend. But also there's the deglobalization and nearshoring and reshoring within the United States is creating need for industrial space capacity. So industrial is a core asset type institutionally. Now you go to retail is kind of coming out of 20 years of restructuring. So its fundamentals are getting better, but it's further down the stack. Office is entering its 20 years of restructuring. And so there's a shakeout there that is only just beginning, particularly for B and C assets and non sort of super amazing, locations and brand new assets. Hotels are very volatile right now. There's a lot of cash, so hotels are okay, but it's a very opportunistic kind of place to be. So there are also interest in sort of, I'll call it select subclasses. Things like single family build to rent is a new subclass. Student housing has some great fundamentals in the right universities. That's a little subsector. Self-storage has the resiliency of being able to do rent increases even when asking rents are down. So there are certain sectors that are of interest in consumer-facing asset types. But I would say multifamily remains, in terms of the depth of the asset type, the size, the need, one of the premier institutional investment asset types. And that's a big change from 20, 30 years ago. I mean, multifamily was not the belle of the ball at all, but that has increasingly been the case, and allocations have reflected that over time. And I believe will continue to do so.
And are you seeing, Mary Ann, John, are you seeing investors looking at some of these growth niches as opposed to the broader multifamily, build to rent, for instance, or student housing? Yeah,
build to rent, student housing, and now probably even workforce housing are the three biggest niche products in the multifamily space. And people that are looking for more yield than they can get in traditional multifamily will look into those spaces. We're seeing that especially as foreign capital starts to really come into the living sectors. Jeff just referenced the fact that the pension fund capital didn't consider apartments an accepted asset class until, late 90s, early 2000s. And when the pension fund capital was unleashed into commercial real estate and into the apartment sector, our cap rates fell from 7 to 4. I mean, it was a huge impact of this new source of capital. Well, I feel like in the foreign pension funds, they're just starting to learn about apartments or the living sector is what they call it.
Right.
And I think that they are where our pension fund business was 20 years ago. And I anticipate a lot more capital demand from foreign investors over the decade ahead. And that will, of course, be great for, a pressure on cap rates and the amount of capital in our sector.
Well, a lot of the foreign investors that I deal with, their first go-to was first offices in major U.S. cities. Okay. Then it was multifamily in major U.S. cities. And so as people are spreading, capital is spreading too, right? So it's not just the top 40 U.S. markets now, but if you look around, again, the U.S. population is spreading, and so is rent growth, and capital is following that. So one of the big sort of demographic or changes was, if you had this conversation 5 years ago, there would be a bemoaning of economic growth is so spiky. It's only in 6 super cities, right? And that's not true, right? So COVID, one of the outcomes or resultant unintended consequences was an acceleration of migration and tech industries into more cities, and then even from those cities into overflow cities. So you have a much bigger landscape that is become institutional investable than was the case even 3 years ago.
Yeah, I think I'll be the only one here to cop to being old now, but I think over the last, I've been in this business a long time, and going back to what Mary Ann said, like 20 years ago plus, they would say like nothing with beds, multifamily is sort of like an outpost of institutional, and it's pretty amazing to me to watch the way the industry has evolved to being, it used to be like office was the super prestigious asset class to be in, and now it's evolved to where multifamily is. And so I think it's pretty amazing. And even over the last 10 years, dealing with pension fund investors 10 years ago, they were like, yes, only, Dallas would be like a sort of a secondary market, and now we talked to somebody, a couple of weeks ago about a deal in, Savannah, and they're like, oh, we love that market. They would have never even probably known where it was on a map. And so I think that has really broadened out the asset class. And I think, again, once we sort of work our way through this little stalemate that we have right now in pricing, I think, that the outlook is pretty strong in terms of a lot of capital wanting to go into this industry.
Well, I think too, investors very interested, but lenders as well, very interested in multifamily, still being one of the darling of the property types. To give you a sense, in 2022, just last year, we did 15 billion of originations, and that included just our core product, including our life company, our core plus debt fund, and also our agency programs. And over 9 billion of the 15 is multifamily. So, it continues to be something we focus on. I think all lenders are focusing on it. And then when I looked at kind of what have we looked at kind of year to date, 80% of that, and that's to your point, Jeff, was 80% was multifamily and industrial up until this point in time.
Yeah, one of the interesting things as a buyer, I'm a former lender as well, is that a lot of the debt in multifamily, specifically around the agencies, is not 100% what I would call risk-based priced. So you can buy a property in a more secondary market and get close to the same pricing you would get if you were buying it in a very much a primary market. And so I think that spreads the liquidity out even more.
Yeah, especially if it's mission driven. I think you mentioned that, Mary Ann, in terms of housing and the importance of housing and affordability. The agencies, both Fannie and Freddie, very focused on that kind of mission and workforce housing, type of product.
Yeah.
So let's talk more about the lending side. And Melissa, what types of lenders are most active now, and what are they focusing on, which you started to address earlier?
Yeah, I think we were talking about non-bank lenders in a sense. So the banks, they're out there, they're still lending, there's no question, but they have definitely pulled back, which has kind of opened up a little. I mean, they're the largest kind of lenders in the space. So once they pull back, that opens it up for others, including, the life companies are very active right now. And loans that, everyone's chasing the same loans, right? So it gets very competitive. And so you'll see, because you're going to see everybody with, lowering spreads and trying to get that one particular loan. But, you know, the actual loan to values have definitely declined. So as we're saying, you know, in the sales market, oh, wow, we have rates going up. This is what's happening to prices. Well, as rates are going up, loan proceeds are going down. And so that's impacting that as well. So that's opening the space up to the debt funds. The debt funds it's a great time to be a debt fund, considering the, you know, the type of asset you can lend on. You used to lend at, you know, 70 to 75. You're now lending at 60 to 65. You know, you're at 530 SOFR plus high 200s, low 300 spread. You're over an 8% right now on just a pretty straightforward transitional debt fund deal. So the debt funds have definitely entered the space. Obviously, the pullback of the banks has impacted the debt funds a bit, especially if they're doing, you know, more leverage loans, you know, loan on loan type financing. But we're also seeing, you know, alternative lenders in the sense of the kind of the pref equity, the mezzanine players step in. You know, there's definitely a gap now with these lower leverages that lenders can actually reach. And everything right now is being based upon debt service coverage ratios. That's really the key. If you would have, you know, asked me 18 months ago, I would have said debt yield. Everyone's focused on debt yield because rates were so low that your debt service coverage ratios weren't even coming into the equation itself. And now every loan that we quote anyway, you know, that's really the major factor.
Yeah, and I would add that everything is situational. So assets that need to be refinanced that are stabilized with good cash flow, you know, little concessions in delinquency problems. Now, those loans are going to the fixed rate lenders for the most part. We've got an inverted yield curve. So for a 525 and going up. So with treasuries, the longer end of the curve at 4% today, 60 days ago was 3.5%. A fixed rate loan was a much better coupon, and generally where those situations or those borrowers finance their transactions, whether or not it was a new acquisition or more typically a refinance. In the debt fund space, we're a floating rate lender, and while it's good to be a floating rate lender as an alternative to a bank in this environment, and we are winning business, it's still tough. And the tough part of it is oftentimes we're competing on a refi with the existing lender. Why wouldn't you just refi or try to extend with your existing lender? So that dynamic exists out there today. It's the saying, kind of an old saying, sometimes in times like this, your best lender is your existing lender. And that definitely is the case. And we've lost some business to the existing lender, so to speak, where borrowers come to us with a refi and they're simultaneously negotiating with their existing lender. And oftentimes that's the best path. Situationally on the floating rate bridge loan side, you just need to find that situation where there's a short-term interim need. So that's really what we're looking for. So situationally, it could be an owner that has heightened delinquency as a result of something like an eviction moratorium, and that's no longer in place. And we can get comfortable with a low debt service coverage ratio or low debt yield with the idea, and we could get comfortable underwriting that they can solve with the lifting of an eviction moratorium, the delinquency problem over time. And they just have that short-term need. So we've won some business in that regard, or we've won some business where there really is a true value add business plan, and that's the traditional bridge lender or bank type of financing. Since the banks aren't there, these value add deals are perfect for debt funds. And as Melissa had said, that's so for 525, a 3% spread, that's a really good return on a bridge loan that we have not seen in a long time. And I would add, not to get too long on this, there's situationally other areas where some of us debt funds are winning some business. So on some of these recaps, the existing lender is willing to stay in conjunction with a pay down of the existing loan. So bridge lenders can come in, or debt funds can come in and provide mezzanine supplemental financing or pref equity supplemental financing. So we're finding opportunities there as well. And that's a more creative recapitalization where the existing lender comes in and we're supplementing additional equity coming in with mezzanine or preferred equity financing.
Okay, and Jon, you've done some preferred equity deals, right? What are you looking for, and what kind of opportunities are you seeing for equity providers?
Yeah, so we are primarily an owner of multifamily, and so I like to say that I think these days everybody's either giving or getting preferred equity. It seems like on a lot of deals, and so we don't normally it's not part of our normal sourcing to even look for these, but we ended up finding a couple of preferred equity deals, and we've done some. I think the conversation really started. We were talking to one of our investors, and we brought him a traditional deal, and we said, "Hey, here it is, and it's a 13% internal rate of return." They're like, "We just did a pref equity deal at 14%. Why would we do this deal and take that kind of risk?" And so that's kind of, I think when we were talking before about different places where people are investing and they're looking at student housing or built to rent or workforce housing or whatever. I think another place where a lot of people like us are going also is looking at doing some preferred equity deals where we can get that value add return almost by putting a slug in there. And for us, it boils down to, again, just like Jeff said, does the deal make sense? But also, there's the concept out there of rescue capital. And so what we've been approached by a number of people who seem to be up against it based on the bridge debt that they got 2 years ago and the interest rate caps that are expiring. Those deals are less, I think people feel like there's opportunity in those. Those deals are less appealing to us because we don't necessarily see a way out of those, and they seem to be underwater. I'd be curious to see what everybody else thinks about that, but those are a little scarier to us, and we've otherwise just been more the ones we have done have been to either on top of new construction because the construction debt just didn't come out to where they needed to be, so getting involved with a new construction deal, or on a refinance where there was seemingly plenty of room, but they couldn't get there, and it seemed like a solid deal.
I would agree with that, John. I would say while we are finding our spots, it's a very low hit rate.
Yeah.
A lot of the refinances we're seeing don't even support mezzanine or preferred equity capital coming into the transaction without additional real cash equity coming in from the sponsorship.
Yeah, 100%.
And I think you're absolutely right on the construction front. I mean, with the banks pulling back, it's hard to find the construction money.
Mm-hmm.
Some life companies are doing some construction lending, and they could be anywhere from, SOFR, 300 to, depending if there's a recourse position, or all the way up to 500 if it's kind of like a non-recourse. But I do think when I look at kind of the pref equity mezzanine deals we're looking at, the majority of them are the same thing. It's the mezzanine behind, or the pref equity behind the construction lender. The problem these days right now is you're having a harder time finding the construction lender than you are finding, the groups that will go behind it as a pref equity piece.
Yeah.
Let's talk more about construction lending, because as you said, that is a challenge now. Are you seeing a lot of construction loans falling out? How much is really successfully moving forward right now?
Yeah. Well, I think it's incredibly difficult today to source a new construction loan. I know when you talk about construction loans falling out, once a guy funds a loan, he's in the army until the deal's completed, because that's how, he gets repaid. So I wouldn't say they're falling out at that point, but it's very difficult to get a commitment for a new construction loan today. Most lenders are under regulatory pressure to really reduce their exposure to higher risk real estate loans, and construction loans are in that category. But it's not just the construction lender issue. It's the fact that that's combined with record high construction costs, large pipelines in many metro areas, uncertain rent because of the pipelines that are coming in and the concessions that are being charged. It's hard to underwrite those loans. And with so many existing deals selling at discounts to replacement cost, it's almost impossible to source equity for new development deals, because why should an equity investor invest in a property at 100 cents on the current dollar when they can buy an existing deal that's a couple of years old at maybe 75 cents on the dollar? So, I think those are all of the pressures that are really making new construction development deals almost impossible to put together today. It is largely construction loans, but it's also combined with all of these other factors. But there is a silver lining to this for all of us in the business that have been in the business through cycles. With almost no starts breaking ground in 23 and 24, 25 and 26 should be two of the strongest years in our business. So that's where you hear more and more people in the real estate business saying survive till 25. So these are tough years. They are going to result in a phenomenal rebound in our market that we've all seen before. So, hang tight.
And-
The data, we track about 25,000 properties in some form of new supply. And so there's about 1.1 million units under construction. We think 485 delivers this year, 505 next year. The open question is what happens in the following years. Okay. There's about another 1.2 million that are planned. They have an approved plan, but they haven't yet gone vertical. Those are the ones that are struggling. We see them sort of stacking up. And the perspective is another 3.1 million units that they have had a discussion. They may have even filed the plan, but they don't have it approved yet. So all of the housing that's necessary to resolve the housing shortage has already been identified. We don't have to wonder where it is. But the struggle is that those prospective deals are stacking up, and they're not moving forward. It is difficult to get construction, financing through. People are very active, however, they are searching long and hard. And there are still markets where rents are growing. And again, if you're looking at construction today and you're delivering in 26, you can make an argument that says, look, if I can get my deal delivered and be in 2026, given the lag times, that's the best deal you could ever make. Go back to the GFC. Folks who were able to get stuff in the ground and get things financed in 09 and 010 when they delivered, crushed it, right? But it was basically getting financed through that time frame that was difficult. But to those who did, the returns were enormous. So, people are aware of that dynamic. It's just actually getting it all the way through. And there is a lot of alternative construction debt sources, private funds, both domestically and internationally, that would like to help. But relative to the size of what the commercial banks were doing, it's relatively small. So some will get done, but not near as much as people would like.
And in fact, it's that focus on pipeline. I see more investors really drilling down on pipeline because things are changing, and the deals that are in the plan category, many of those can't get financing. They can't get out of the ground. And, I look pretty simplistically at the reason why our national rent growth looks like 1.8%, here in June, is because we're delivering 485,000 units this year. And to the extent that our deliveries go way down, our rent growth will go up. And investors are starting to ask that question. Before I go to committee, I want you to drill down on the pipeline in this area and tell me how many of these deals are really going to get built. So I know my teams are working in all of our markets across the country to vet that and to update it because it's changing.
I was
gonna say, I think one thing that people like us are looking at also is that there's a lot of new construction, obviously, this year, and a lot of that's all we just talked about, the way those things are financed. When that thing opens, and a lot of the builders, are merchant builders, and they need to get out of those construction loans. Is there an opportunity on the acquisition side there? Is that where we're going to find some kind of opportunity? Because when we talked about motivated sellers, these are motivated sellers.
And we're tracking the lease up pipeline, the sort of lease up progress at each one of the projects. When a project stall, we're already seeing in Austin projects begin to stall, right? And so within that, there will be some developers who do get over their skis in high supply markets. They happen to deliver just at the wrong time, and they're going to need some kind of recapitalization to sort of get them through. We're beginning to see that. We'll see more of that, as the rest of this year progresses. And I would say by the fourth quarter, you'll have some pretty good handle on high supply markets where lease ups have struggled, and those will create an additional set of investable opportunities.
I think from the lending perspective on this, is trying to get these loans off the bank's balance sheets. Part of the issue is the bank's balance sheets have ballooned because there's no sales transactions, right? For some of these loans actually, move off of it. Even when you look at the debt funds, I mean, our particular debt fund, I'm curious for you as well, Josh, is a lot is not paying off right now because what's the alternative? Typically it was a sale. That was how, these loans exited. So I think, it goes back to the market kind of being in that standstill that, until the banks can get the loans off, they're not going to be able to make too many new loans. Some of the deals we're looking at are, in lease up right now. So, it's kind of like the banks are gently pushing their clients, because obviously it's a very relationship business, but gently saying, hey, let's see if we can get this one off. So we've been looking at, apartment deals that are about 50-60% leased, trying to bridge them into more of a fixed rate, permanent loan.
So
and I would add,
go ahead.
I would add to Melissa's point, the primary exit is a sale. Secondary is a refinance, but when you look at today's environment, we've got higher interest rates and tighter lending standards. We have rent growth moderating and stagnating, and higher construction costs oftentimes, kind of balloon some of the budgets and the loan amounts for some of these projects. The net result is a refinance exit as a backup isn't really available in most cases. It's available at lower proceeds requiring additional equity, which goes back to our prior discussion, which is, does it make sense? And is there an opportunity for mezz or pref equity to solve part of that problem? But the more macro problem is these construction loans are not getting paid off because there's not a sale market, or there's a very, not a robust sale market, put it that way, for the environment. And then the backup, the traditional refi backup, has been hindered by the fact that you have higher rates, tighter lending standards, and kind of some of the economic fundamentals given new supply and everything that we're talking about. We don't have the income in a lot of these properties to simply refinance. So that's the conundrum. And we're all trying to solve it, and we're all trying to kind of play our part in it. And I think the overlay to it is, I think Mary Ann had said this earlier, it's stress, it's not distress. So these owners have not lost the equity in their properties. They may have some partial impairment to their equity in today's environment.
That's right.
But these are all the problems that we're trying to solve right now.
So along those lines, let's spend a few minutes before we turn to Q&A talking more about the stresses in the market, besides the elephant in the room. I know there's other stresses that are contributing to the current investment market. Jeff,
Yeah,
would you like to start
so
that?
we have the economic slower job growth, still good. It's a very tight labor market, slower levels of migration are all coming in. The new supply short-term we've discussed, which are leading to declining rent growth in most markets, but not all, and a pullback in occupancy off of COVID kind of peaks. But also there are rising expenses, particularly in insurance and particularly in property taxes. So you're not getting a relief in labor costs. You're getting significant increases in these other areas. Material costs have really come down, on an operating cost basis. So expense pressures, which you could kind of wave away when rents are growing at the level they were growing, you can't now. So expenses are an issue. Also, I would overlay, there are regulatory pressures, and they are non-trivial in certain jurisdictions. And you're seeing it in California, where you have this built up delinquency, which in LA still isn't being resolved. You have suppression of rents. And I'll shift to one of the questions that was asked. Canada, particularly Ontario, is the classic example of what happens when you have 40 years of rent control. They have not had nearly the kind of supply that we talk about, what these sort of cycles. Well, that hasn't happened in Toronto. There's been no new supply of apartments because they've had rent control in place for 40 years. All of the new supply got added into very high-end condos that made its way into the sort of gray market. And they've encouraged immigration. Their population grew 3%, so they got a lot of new people with no new housing, and they have a massive housing shortage. And and their political discourse is, rather than getting rid of rent control and incenting supply, it's how do we put on more rent control? It's a very vicious cycle once it gets going. Now, in the United States, one of the differences is people get up and leave. So if things get too expensive, they move, which is a big relief valve for the United States. So those are some of the stressors. There are opportunities inside of this, however. We are going through a deglobalization, and I'll call it nearshoring and reshoring of productive capacity. The US has tremendous energy resources, almost uniquely in the world, in terms of food, water, and energy. We have a sort of with Mexico and Canada, a very large integrated manufacturing capability that's nearshoring out of China. Our demographics are aging, but people are healthier. So that is helping, but we have our older Americans have on a proportional basis dropped out of the workforce to a greater degree. So that's what's driving our labor shortage, and we don't have an immigration policy. So we have these sort of combination of pushes and pulls. Generally speaking, we're still in a good place, okay? But there are places that are now having their moment in the cycle, right? So Midwestern markets like Indianapolis, Kansas City, St. Louis, Dayton, Cincinnati, Madison, Wisconsin, Albuquerque, El Paso, Northwest Arkansas. These markets, well, we're saying 1.8% and things are declining. These markets are growing at 5, 6, 7, 8% rent growth. They're smaller markets. They're either on a manufacturing corridor, or they're benefiting from reshoring or spreading the population. So there are interesting opportunities within this environment, even over the next 2 years. So it's always a question of finding those particular sort of spots where the puck's moving. And I think there's stresses, but there's also significant opportunities within that.
Okay. I also want to touch on the distress situation before we shift over to Q&A, and we do need to do that. Sure. Josh, how much risk of distress do you see now? How much of a concern is it? How much of the market is it?
I think it's a small proportion of the market. I kind of said it earlier. I think, we're, as a generalization, you'd say, we're the industry, multifamily as an asset class is undergoing a period of stress, but there's nothing structural in the industry other than absorbing new supply, and that's not really a structural thing. It just happens on occasion that the industry is dealing with. As we're sitting here talking, I'm thinking about everything that is going on in different asset classes in commercial real estate. Office is going through a secular, just major structural reset with work from home, and it's dramatically impacting office. Industrial, to the positive, is going through onshoring, supply chain disruptions, or in many ways helping the industrial market, and that's going through structural change. Hotels are going through business and leisure. There's been a divergence between values, incomes, occupancy, ADR, between business and leisure, in urban and suburban, even in urban versus destination. So there's a lot of change going on. Multifamily is not going through a secular change right now. Right now, we're dealing with interest rates and things that our industry can handle and get through, versus some of the other challenges in other asset classes. So I think for multifamily, I don't see anything in the future that's going to cause increasing levels of distress. I think fundamentally, it's a strong business. You kind of want low volatility and low return. That sounds great to us lenders. And I would put multifamily right squarely in that category.
Okay, on that note, let's turn over to Q&A. We do have quite a few questions from our audience. Thank you so much. I'll start with a question about cap rates. It seems that they've not risen to debt equilibrium. Do you expect that to happen in the near term? And where's the stress showing up, if anywhere? Who wants to take that?
I can start. I'm sure Mary Ann wants to jump in on that too. Yeah, I mean, I think they have to go up. I mean, it's, that's the way the market functions. I like to say sometimes acquisitions are a bit of a math problem. And so for the math problem to work, we're going to have to find the place where the cap rates, get to where the interest rates are, or that we have the growth necessary to sort of bridge that gap. So I think, long term, I also see, we cover, 9 discrete markets, but we're sort of mid-Atlantic, Southeast, and Texas. And I see throughout the country, our part of the world, a difference where in Texas, which has been, which is places like Austin and Dallas, which have grown so much, the cap rates still have not bumped up as much as in some places here, like in the mid-Atlantic. Specifically, we've seen the cap rates have really adjusted because the growth isn't as high. And I think, people that want to sell, they're motivated sellers, are starting to meet the market. So I think it'll get there. It just takes time. I don't know if Marianne agrees or disagrees.
Yeah, I do. I would say that, but I recognize the truth in the comment, and that is when we're selling core deals, for instance, I would say majority of the core deals are going between 4.75 and 5 when debt rates were in the mid to kind of high 5s. So why is that happening? Well, it's happening. I think people are pricing deals to cover debt service within 12, usually within a year, but sometimes as long as 24 months. And so obviously what comes into play is, what do they think is going to happen to rent growth? If they're in a market that's where the rents are only increasing, 1%, they're not going to get that far away from, debt rates, because they're not going to be bailed out that much by rent growth. We see the most activity in the value space. In the $50 to $75 million range, it's accessible to a wider swath in the market, and people can buy a deal that they're looking to, a deal that is going to stabilize between 6 and 6.5, but it may be trading in the 4s now because they think there's a value play. So the deals that are trading, everybody's got to cover debt service. The only question is, do I have to cover debt service on day one, or am I going to grow into that debt service? And over the next year, as we deliver all this product and as we're stressed with rent growth, I do think cap rates are going to get closer to debt rates. But as you start to see markets coming back and rental increases happening, there's going to be a respite in there. So, and I think it's interesting to look at exit cap rates, which people are holding pretty close to par. So if they're going in on a core deal between 4.75 and 5, they're often looking at an exit cap rate, which means they think that, rates are going to come down into that range. So there's a certain sense that long-term rates have almost peaked, maybe not exactly, but very close. Most of the pain is behind us, and there's more of an opportunity for cap rate compression ahead of us than there is increasing, gapping in the market.
And to piggyback on that, just from the debt perspective, on those core deals especially, we've been putting in loan to value steps and saying, okay, when the appraisal comes in, like, we'll buy off on the fact that you're buying that at a 4.5 cap rate, but when the appraisal comes in, they better also confirm that you're at 55% leverage or less. Yeah. And I think that's become even more common, especially in the core space specifically, it's become very common. And in the appraisals in the beginning, though, they were nowhere close, that they couldn't catch up because there wasn't any transactions, and they need to see those third-party transactions so they can then, make an educated guess on what the value should be. So now we're starting to see a little bit more transactions. So we are getting some, the cap rates are increasing in the appraisals that we're receiving.
Yeah. I also think there's more of a variation in cap rates because, especially in the core space where where the audience is narrower, there's a core deal out there that'll trade at 4.25 because it's the perfect post-COVID, product in a market that's got good rent growth. But there's a product down the street, not too far down, that'll trade at 4.75 or 5 because it's a little bit more commodity core and the submarket is a little bit different. In 2021, it seemed like everything traded at 350 to 375, whether you were in suburban Albuquerque or, great markets in Florida. The cap rates are spreading as you see a a thinner market, depending on who comes and what the appetite is for that asset. I think
Yeah.
you're seeing more variation.
Yeah, I think something as a buyer that sometimes is kind of frustrating, a little bit, which is probably part of the question I was asking, is we also get, it depends on, a cap rate is always the devil's in what are you capping? And so
Yeah.
somebody will call us and say, hey, it's a great deal. It's a 6.5 cap. And yeah, it's a 6.5 cap when we trend the rents and all that stuff. Today it's a 375. It's like, we I don't, it's the way the business works, but it gets frustrating. Sometimes we could standardize what we're capping. It'd be a lot easier for us to screen these deals than try to, solve for what are you capping? And one other thing, just to throw into the discussion, which we sort of talked about in the last piece, though, is one of the things that's impacting this a lot is insurance, because in the old days we used to get, a broker would send us a deal and they would say, it's T3 and then tax adjusted, because you're always adjusting for the tax increase. But now we're doing tax and insurance adjusted because the insurance has gone up so much. And so, people not, a lot of people obviously know that's happening, but sometimes we still see people that are still, no, the insurance is like $300 a unit. It's like, it's not anymore, especially in Florida or something like that. So
I was going to say Florida and California are the biggest concern. And we were actually talking about just yesterday, what if a property can't get insurance?
Yeah.
What do you do in that situation? You're lucky if you have a very strong institutional sponsor that has a blanket policy and they can cover all the markets. But if you have a smaller sponsor and they're all focused, say in Florida, or all focused in California, or closer to the wildfires, it's a concern. It's a real concern in the industry.
Yeah, and we have a couple of questions about insurance here. So certainly there's concern out there among our audience about both the impact of the high cost of insurance and what's going to happen going forward as we have the anticipated greater climate related hazards out there. Melissa, you just referenced the wildfires.
What's happening?
How do you see those things impacting insurance rates and those impacting investment long term?
So in a previous life, I actually was an insurance executive, and I also was a risk manager for a 160,000 unit portfolio. So I know a lot of people in the insurance business, and what they're kind of saying is like the insurance industry has gotten hit so hard from so many different angles that rates and availability absolutely are going up, and that owners are going to have to lean more on captives, on additional risk retentions, because the capacity isn't there, or Florida has some capabilities in terms of its government insurance company, but there's a lot of problem. There's a lot of stress, and it's not just in Florida. The increases are spreading all over the United States. So insurance costs are rising rapidly. They're the indications of when a soft market would reoccur. You'd have to have a dramatic decline in interest rates that suddenly made gathering premiums worth more, and that's not the case. And they do some very sophisticated kind of modeling of costs. So now the severity has also gone up significantly. So remember, it's not just the frequency of loss, the losses themselves have gotten more expensive, and a lot of the insurable values did not catch up. So it is a big problem, and it will tend to benefit large owners who can put together portfolio or blanket policies or have enough insurable interest to create captives. I ran a captive, and you have to have a bulk to be able to absorb small losses to be able to make all that work. So it is a significant challenge. And remember, you also have property taxes, which roll 3 years late. And that big increase in value that is now maybe topped off and coming down a little bit. The taxes are just catching up to what happened 2-3 years ago. So those pressures are not going to go anytime anyway soon. And that is going to put pressure on values.
Yeah, we see this most stressful part of the deal used to be, what's going to happen with the interest rate. Yeah. the good old days of a couple months ago of, what's going to happen with interest rates. And now it's like, white knuckle moment when the insurance quote comes in. I think a lot of deals have fallen apart. I know somebody told me in the industry that they had a deal, they actually put in the contract that if it was in Florida and if they could get insurance of $2,000 a unit or less, they'd go forward on the deal, or otherwise they wouldn't. So, it's a linchpin in a lot of deals now, where it used to just be an afterthought. Yeah, get the insurance, put that on there, have the lender talk to them. So and the other issue that we have is also, the coverage that you need, and this is something maybe Melissa can talk about. We have found ourselves going back to the lender now saying, these are the insurance requirements you gave us. That just tripled the cost of our policy. Is there any leeway? So.
Okay, well, thank you all. I wish we had more time. We are unfortunately out of time. But hopefully we covered a lot of the topics that were addressed in the audience questions. We will be sending you out a link when the recording is available. And we hope you'll be able to join us for our next MHN webinar on HVAC technological advances, which is coming up soon. Actually, our next one, I'm sorry, is smart upgrades to combat rising utility costs on August 17th. We also have more on the commercial side offered through our sister publication, Commercial Property Executive. So plenty of past and upcoming webinars there covering some of these topics. Meanwhile, I would like to thank our speakers once again for this very interesting discussion, and thank you all for joining us today.